Today we have with us Ram Kalyan Medury, the founder and CEO of Jama Wealth. Welcome, Mr. Medury, to LifeMint.
Thank you so much. Nice talking to you, Meghna.
So, as New Year is round the corner, investors will look for more investment ideas and revisit their money goals. So, let me start with this. If investing is somebody's New Year resolution, how do you think that person should get started?
See, starting always starts with a financial plan. As a SEBI registered investment advisor, I'll always recommend having a proper financial plan, goals, retirement corpus, children's education, etc. Understand risk appetite, know what component can go into equity and what can go into debt, and then make sure there's a healthy allocation between the two. Debt should cover your next 3 to 5 years of living expenses at least. When I say living expenses, I'm not talking about emergency fund here. I'm talking about college education or an important house down payment, etc. Make sure so much money is there in debt so that you can sleep peacefully. You should not have, end of the day, everything has to result in happiness. So, secondly, make sure there's enough money invested in equity because that's the only asset that can generate wealth over the long term. And that is a good mix for you to get started with.
So, do you think asset allocation is integral to financial planning?
Financial planning typically always results in an investment plan because financial plan tells you where you need to go, right? I need to amass, let's say, 5 crores in 15 years for my retirement. I need to amass 1 crore in 12 years for my child's education abroad. So financial plan tells you where you need to go and what are the milestones in the journey. An investment plan tells you how you need to go there. And if, let us say, in the journey there is a small roadblock, how do you make a detour and get back there? Right? For example, markets fall. How do you make a rebalancing and get back there? So an investment plan is a very good corollary of a good financial plan. There could be cases where a person may not need to invest. Maybe they have a lot of wealth already. But in our experience with the hundreds and thousands of clients that we talk to, an investment plan typically is a necessary corollary, and one needs to then make sure the investments are in the correct buckets so that the financial plan is achieved at the end of the day. Because financial plan achievement ka matlab hai happiness.
So, what are the key things to keep in mind to organize funds that can help in building wealth, securing life, and also reducing the tax burden?
So, on taxes, make sure that you invest in the tax-friendly instruments. Everybody knows about Section 80C. There is a little bit of NPS, though the lock-in is very, very long there. So, PPF is an excellent instrument. Sukanya Samriddhi Yojana. So these are there for mostly I would say, the mass affluent investor profile. For the HNIs and ultra HNIs, they probably need to more worry about what are the taxes that come out of gains and how do they need to manage things like tax loss harvesting. But we need to remember that if you're paying tax, it means you've made good gains. So don't worry too much about taxes in your investment planning and rebalancing, etc. Do what is right. You can always do tactical rebalancing at the end of the financial year to take advantage of any tax aspect. But otherwise, the tax part is a much secondary thing compared to the primary investment aspect. We already talked about asset allocation, equity, debt split, and if you want to diversify, so the key is to diversify your assets within equity, right? Large cap, mid cap, small cap. And there also the other diversification is in terms of what stocks you buy and also some funds. So we typically recommend buying a good index fund and having a good exposure to high quality stocks that a good equity advisor can give you so that you get the best of both the worlds and you're not concentrated too much in one area. So good mix of equities, debt portfolio where there's a good amount of preference for government instruments because then the risk is very, very low. because government has a lot of power in its hands to raise taxes and etc. So the credit risk is low. Interest risk is there, but interest rates are all cyclical. So long-term investors should not worry about what is happening in US in terms of interest rates, inflation. What is the impact on India? Interest rates, inflation, or things like that.
So, what do you think the first week of New Year has in store for D Street?
First week of the new year, it will be more of the same. I don't think just by changing one date on the calendar, suddenly a new era will emerge or stuff like that. It's not like a new government coming into play with a new set of policies, right? So, however, if you look at what's happened in 2022, the Indian markets have stayed resilient. Global markets are under pressure. uh, I would expect some more bad news to come in the coming weeks from on the global front. Whether it is US market, the inflation, the housing, we are seeing almost another housing bubble in the US, whether that will be under pressure. And we're hearing some bad news out of China in terms of how COVID is getting out of control now. Lots of casualties emerging out of that. So maybe there could be impact on the supply chain there, etc., etc. So other than that, I would see that the Indian markets will be stable. They will continue to relatively outperform compared to other markets. So Indian markets are the good place to stay invested in, and make sure that you have exposure to high quality stocks, and stay the course. In case there's a market correction, do buy more on dips, and keep growing your portfolio.
So, what would be your top stock picks for the upcoming year 2023?
See the uh, sectors that are likely to do well. If I look at the kind of momentum they've generated, not price momentum, but the amount of capital investments that have happened. For example, chemicals is a good sector that is out there, and we all know what are the top few good stocks there. We typically don't name stocks in discussions, but yeah, there are good chemical companies there. For example, a PI Industries is there, or a Vinati Organics is there. Some of the fertilizer companies are also there, for example, Coromandel International, etc. So these companies are positioned well in terms of the capex investments, which will likely bear fruit. And banks, definitely high quality private banks we would consider. PSU banks have run up off late, but in general, I'm wary of PSU banks because of the higher the net non-performing asset ratios that they carry, regardless of the price aspect. I would first focus on fundamentals. So I would say the banks are key for economic development, and these are some of the sectors that are likely to do well. So a good investor can pick really good stocks with consistently high return on equity, consistent earnings growth in these sectors, and hold them for a considerable period of time to benefit from the growth.
So, what is your opinion on real estate as an investment?
We look at investments as liquidity, safety, and growth, three buckets. And liquidity, we spoke about earlier. Uh, Safety, also sleep peacefully for the next 3 to 5 years. Growth is the equity part. Now, real estate falls under the safety bucket. Because if you really look at any market, you take the Mumbai, South Mumbai market, or any market in general, take a 15, 20-year look. Real estate has not outperformed equities. So therefore, the returns are in the long term mediocre. It's not a highly liquid instrument, and so therefore, my request is to not go aggressive in real estate or do speculative bets there. Treat it as a safety bucket. Have adequate real estate for your primary requirement, which is one house. If you have a lot of money, maybe one more than that. But other than that, I don't think real estate is going to do better than equities in the long run.
So, what is your current asset mix if you would like to share with our viewers?
So this is a highly individualized number, because it all depends on what is the risk appetite, what is the age, so many things. So it's very difficult to give a um, uh, you know uh, mass kind of an answer to this. But as a thumb rule, let us say if somebody has a mediocre risk profile, is a moderate risk profile, um, I would say maybe a 60% to equity and 40% in debt is a good allocation, provided you rebalance regularly. The 60-40 number, or it could be 40-60, is dependent on you. But if I were to interpret your question differently, Meghna, equity, don't just go zero on equity at this stage. Okay. Yes, there will be bumpy rides, but the problem of going zero into equity is that when equity gives that great opportunity to buy, a lot of people don't have the courage to re-enter the market. And we've seen this in the COVID crash, we've seen this in the 2008-9 crash, etc. So arrive at a number that you're comfortable with and keep on to it. And uh, within equity, if you want, you can again further dice it into large cap, mid cap, small cap. You can dice it into high quality equities and index fund, as we talked about earlier. So that within equity, maybe a 60-40 split again between large and mid cap / small cap would be a reasonable mix for most people. But again, this is very a personalized answer.
So, what about international exposure?
See, at this stage, we think India is the best market. So India will rule the next decade. So we are overweight on India. However, जैसे दाल में तड़का चाहिए, if somebody wants a little bit of variation, maybe take a 5, 10 or 15% exposure outside India, but not more than that. So international exposure, again, take it through index funds. Feeder funds are there. Or you can have even buy a few stocks, but the US market is going through a lot of turmoil today. So it would be difficult to name a specific stock because the tech sector has done very, very well till recently, and now it's corrected big time. And tech has dominated the entire economy for the last 10, 15 years. So when the next bull run emerges, it's unlikely that it will be the same set of rulers, and a different set of rulers might emerge. So it's very dynamic there. India, we know there are the problems here, the governance quotient that we have today. What are the opportunities, etc. So we are definitely overweight on India.
So, do you have any newer resolutions?
Again, see, like I said earlier, it's just another day. Stay happy. That's the only thing that stay happy. Make sure your investments don't let you lose sleep. Don't do risky bets. Don't do leveraged bets. And personally, my resolution would be to complete the book that I have, that I'm, almost on the verge of finishing on investments and investment styles.
Thank you so much, sir, for joining us and for that insightful conversation.